would argue that the economy is not recovering.
I am most concerned if, in fact, it is recovering, because I don't believe that the Federal Reserve System has the resolve to take away the liquidity that they've created to bring us out of a deflationary morass. If they don't take it away fast enough, you will find yourself in a super or hyperinflation.
It's vital to remember how important the consumer is to the velocity of money and the turnover of the national income.
The velocity of money is taking the stock of money or capital in the system and counting the number of times that it gets run through the system. The greater the number, the more robust the economy, the greater GDP growth. And what we have had for the last 18 months is a collapse in the velocity of money. You take 3 trillion created and multiply times 10, what's the impact in the marketplace of $30 trillion? So there actually is an ironic imbalance created by recovery. If the economy recovers right now and the Fed is not disciplined enough to take away the punch bowl, that is likely to throw us into superinflation or hyperinflation within 6 months.
As we look at problems both in the sphere of the economy and in the financial arena, I would suggest one solution.
End the Federal Reserve. End the Fed. If you end the Fed, you take away the power that Wall Street has. You take away the power that Washington has. Washington has an unlimited amount of power because they have an unlimited amount of money.
The Fed, for all the benefits that it brings us, supposedly, is really nothing more than a banking cartel. So we now have the third central bank of America, started in 1913 with the passage of the Federal Reserve Act. Do we need it? We determined we didn't before. I think we need to determine the same again. We cannot avoid crisis. We did not avoid the crisis of 1929, even though the Federal Reserve existed at that time.
We did not avoid the crisis of 2008. We have created crises as a result of easy money policies, but have never prevented crises, which was the original argument for why we needed a central bank, why we needed to resurrect that which we had violently killed. That if you create too much money, you will corrupt a political system. That was the argument by a past president, not a past radical, not a past terrorist, not a past Tea Party person, President of the United States. Do we need to uncover that argument again? I think so. Can we prevent crises? No, we cannot. Can we create crises as a result of easy money policies? Assuredly, as night follows day, tomorrow there will be a new crisis as a result of the easy money policies of the Fed.
The debate has raged as to whether or not the gold standard is the most efficient and the best way to manage our money system. And the argument against was always that government or the Federal Reserve System can do a better job, be more efficient, can be more optimal. And the argument for the gold standard was that politicians would be encumbered and be limited in the scope of what they could do legislatively if there was control of the money. Keeping rates too low, too long, has always been a recipe for disaster. Swedish economist Knut Wicksell at the turn of the century proved, and it has never been refuted, that keeping interest rates too low ultimately leads to significantly higher interest rates. If you live on a fixed income, you understand the challenges of living in a low interest rate environment. This is specifically set by the Fed. And the problem is it is creating a misallocation of capital. What should have been income going to savers is in fact going to the banks to rebuild their balance sheets.
You've got a saver in their mid-60s that's put aside $500,000 and was counting on that to supplement their income in retirement. And so at 5%, your $500,000 is generating an extra $25,000 before you pay taxes on it. At 1%, it's generating $5,000. And if you were counting on that $500,000 in savings to be there for you as an income generator, you've got two choices. Amp up the returns and take more risk, or cut your lifestyle dramatically. So there's two main categories of people who are impacted by a zero interest rate policy. Speculators on the one hand, savers on the other, who are getting squeezed. Don't take on additional risk. Do whatever you can to tighten your belt so that you don't demand more of your assets than is reasonable in this environment.
The significant part about Bretton Woods in 1944 was that every other currency in the world then related to the US dollar. We were, in essence, the gold standard, but without any of the gold backing our currency. It was just the full faith and credit of the United States of America. Going back a little bit in history, you realize that the full faith and credit of the United States of America changed significantly in 1913 when we could print an infinite amount of dollars. And it's not without accident that that same year is the year that we amended the Constitution to introduce an income tax. It doesn't matter what the rhetoric is about having a strong dollar. When employment and export growth are a priority, the dollar is the first sacrificial lamb.
We end up with a competitive currency devaluation when everyone wants the same thing. When politicians in every country around the world want their people employed for the purpose of political stability. They're not willing to give up political stability. We're not willing to give up political stability. It ends up being a race to the bottom in terms of currency value. No one cares what the currency is worth as long as we maintain a trade advantage. We've lost a third of our manufacturing base just in the last decade. If we attempt to pursue a strong dollar policy, it's at the cost of our manufacturing base. If we pursue a strong manufacturing base, it will be at the cost of our currency. You as an investor have to decide, what does it look like if on a politically motivated basis our administration or the next administration is going to prioritize manufacturing at the expense of the dollar? What does that mean for my savings and my investments? Do you have a strategy that assumes the dollar is going lower on the basis of what is happening in Washington and the policies which will, over the next 10 years, impact the marketplace and asset valuation? If you don't have a strategy, you need to get one.
If you think of the US dollar as the stock of the United States of America, that stock has been sold off precipitously over the last decade, and for good reason. If you look at our balance sheet, we're technically insolvent. If you look at the trillions of present liabilities and the trillions of unfunded liabilities that we pay for decades to come, you understand why the dollar is in the tank and why the stock has been sold off so severely.
When you find malfeasance at the corporate level, when you find deceit, what happens is the stock of that company gets sold off. That is the vote that's being made with the US dollar. The dollar is the stock of the United States of America. We are uncovering, as time goes on, more and more deceit, chicanery, deception, lies, whether it's unemployment, GDP growth, consumer price index. These are numbers that conveniently tell a story for the general public. Ultimately, it catches up with you. The truth prevails. The problem for us is if the truth prevails, and it will, it means the erosion and maybe even the death of the dollar. When we look back and uncover the lies and deceit of the American empire, we'll understand why the market was voting with its feet long before the market fully understood the reality it was faced with.
This idea of dollar recycling, it's worth wrapping our minds around.
If we're buying products that are manufactured overseas, then ultimately a part of that revenue stream ends up going overseas. The issue for that overseas manufacturer is what to do with the capital. They can either invest it in their own economy. If they do, that has a tendency over time of inflating the value of their currency. It also inflates the cost to us, the consumer, for those same goods. So there is a motivation on their part to lower the value of their currency or artificially keep the value of their currency less than what it would be otherwise. It's been convenient for us as a country to run a budget deficit, create IOUs in the form of treasury bills, bonds, and notes, and then have our foreign trade partners take their trade surpluses and invest that back into our debt instruments, our IOUs. It does not increase the value of their currency. It keeps it artificially low. And at the same time keeps our currency artificially high. If we don't continue to purchase, or if there is a recession such that we have to tighten our belts, there's no longer the money going overseas to build a trade surplus with our trade partner. And there's not that trade surplus to put into treasuries and to finance our deficit. How do we finance our deficit if our trade partners no longer have trade surpluses? That's the issue of our treasury crisis, as it's something we get to experience over the next 2 to 3 years. This is a very, very real issue in the context of a global recession, number one, and there being a political motive to purchase of U.S. treasuries. Having our treasury debt held by foreigners means that for a variety of reasons, it might come back to market, it might get sold. It's not just on that basis an economic or a financial decision to hold onto our treasury paper. It could in fact be a political decision that becomes the motivation for liquidating treasuries. Now, this assumes that we don't have an ongoing need for them to buy more of our treasuries, which is in fact not the case. We need to finance close to $1 trillion to $1.5 trillion in new debt every year. We're in a very awkward position this particular year and for the next 3 because we have somewhere between $2 and $2.5 trillion in debt that is rolling over or has to be refinanced in the same period of time. So $2.5 trillion that has to be rolled over and refinanced, another $1 trillion to $1.5 trillion that has to be financed anew from a budget deficit, plus any liquidations which you might see, which we did see in fact in 2009, net liquidations by foreigners of $9.3 billion. And that is really the recipe for how we lose our reserve currency status eventually and immediately see a debt downgrade from AAA.
Over the last 100 years, as a country, we've become debt addicted at every level. As individuals, as corporations, as a governing body, as the U.S. government.
We have too much debt. It's a weight that we now can no longer bear. In the past decade, national debt has grown by $27.2 trillion, while GDP in the same time period has only grown by $4.9 trillion. If you go back 40 years, you'd find that every new dollar in debt that was added to our balance sheet did actually increase gross domestic product by 90 cents. And today, it subtracts away from GDP by 45 cents. Debt is a form of slavery. We've been sold the idea that having more stuff makes us more significant people, when in fact we've found ourselves serfs in sort of a feudal system.